And so this is a tax that Washington feels they need that revenue to offset, this huge, colossal deficit that's been built by Democrats and Republicans. Mm-hmm. And so where does that take us? This is where you could get a rally in the market over the next year, because if you have Democrats and Republicans come together and try to stop Trump, at least trying to, they want more control over tariffs, and where you give global investors certainty and visibility on tariffs, that's what markets want.
Hey everyone, welcome to a special in-person episode of the Julia La Roche Show. We are joined today by Larry McDonald, founder of the Bear Traps Report and author of the book, How to Listen When Markets Speak, Risks, Myths, and Investment Opportunities in a Radically Reshaped Economy, and certainly a friend of this show. Larry, it's so great to be with you in person and great to see you.
Julia, what a week.
What a week.
The book hit #1 in like two or three different categories in finance on Amazon. So thank you, and thanks to everyone.
You're so welcome, and we love having you on the show. And we just had Larry on for folks watching and listening a month ago. It was a huge hit with this crowd because I feel like this book, that thesis is playing out right now. So it's been quite prescient. I know it came out in the spring of 2024. So congratulations on all the success. And I think let's start more of that big picture update, where we are today, bring in that thesis in the book, because you're talking about a kind of complete reordering, a totally reshaped economy.
Thank you, Julia. There's no I in team, right? So what I do in the book is I work with incredible mentors. And for younger people watching us right now, we want to reach out and build those mentors. And so what I've been trying to do over the last 20 years is crowdsource information, work with great mentors, work with great minds. And we shaped this book together in 2021. And I owe so much to the David Einhorns that are in the book, David Einhorn, David Tepper, Charlie Munger. And some people were really good to me. And I worked hard to build those relationships, and just the way you have through life, right? And so I want to make sure that, this isn't about me. I mean, the book's thesis is playing out, but it's a thesis that I derive from talking to a lot of brilliant people.
Which is what you do with the Bear Traps Report as well. And I know you kind of have the pulse of like, what are folks talking about these days? So let's start there. Like, what is the conversation right now, especially what we've seen transpire the last couple of weeks? What's the latest? Well,
so we have this Bloomberg chat. And what's interesting is it's like a conversation with the institutions, and you can see narratives develop. You can almost see the birth of a narrative. What I see is sometimes the narrative starts off and it's a conversation in the institutional crowd. Then it works its way to sell-side research. Then it works its way into the media. So it's like a new way of thinking. And the one narrative that's been coming in the last 2-3 weeks is when you talk to European investors, they've just been all in US stocks and bonds. So massively, massively long, what we call financial assets. And the shock of Trump and the tariffs and the way they went about executing that famous day in the Rose Garden, that shock plus the Biden shock, which jacked up deficits, those two things combined really have convinced European investors to really pull away from the United States. So if you picture in your mind a white water river, violently moving in one direction, and all of a sudden it U-turns and starts going the other way. That's what I'm getting from the European investors. In other words, they're pulling away from the United States and they're taking their money to other parts of the world.
Okay, so do you think that is like early innings of kind of like the U.S. has kind of been the place to invest? It's been, it's been the place. So what does that mean? Like, where are they putting their money? Are we seeing like capital move elsewhere? If so, where?
Well, sell-side research, and all that means is the banks, they've been talking about American exceptionalism for much of the last year. And they really made a lot of people feel comfortable with these crowded trades because of American exceptionalism. And they've used that to justify a really, really dangerous crowded trade. And every bank on the street was doing it. And we got to a point where we are essentially 2 standard deviations higher than like the 40-year mean in terms of global investors invested in the United States. So I'm not saying the dollar is going to lose its reserve currency. We hint around to that in the book, but what I'm trying to say is we're going to go from 2 standard deviations maybe back to the 40-year mean, which is important. And what that really means is to people watching us right now, that means like, $3 or $4 trillion, 3 or 4 trillion, maybe 5, going from the most crowded trade in the world, and that's long U.S. stocks, long U.S. bonds, long Mag 7, long NVIDIA, long dollars. Because right now, if you're a European investor, imagine if you have like $1 million, just keep it simple. You had a $1 million account in Europe. Your stocks lost 17%, almost 20 in some cases, a little more. Your bonds, so your treasuries, also lost about 5 or 6%. It depends on your entry point in the last year. And your dollar, you're losing money on the dollar as well. And so because of that triple whammy, and which is something that you typically see in emerging market country investors. So the fascinating thing, and what I'm hearing from the intelligence gathering in the chat and working this into our research, is that what is happening now is such a shock that, and it's a bipartisan shock. It's not just Trump. It's also the deficits from 2023 and before. And it's a lot of that double barrel shock. Interest is this percentage of tax receipts. But before Trump came in office, we're almost 20%.
Right.
And the rest of the developed world is like 2, 3, 4%. So that's interest.
Right.
As a percentage of incoming tax receipts.
Right.
So we were already shocking the world, right? Before Trump came in. Then he came in with a sledgehammer on the global order around tariffs, and the way they went about it, the Lutnick move and the Navarro move was pretty foolish. And if you're an investor in Europe, I talked to an investor in Zurich the other day. He's like, Larry, we are so deep into this trade, and we are reversing.
Interesting. Okay, because in your book you talk about like we've entered like a new era of an escalation of global conflict, a multipolar world teaming up against America, persistent inflation, weakening dollar, sovereign debt crises, a thundering of capital out of financial assets into hard assets, moving from growth stocks into value stocks, shortage of natural resources, ditching the tech stocks and investing more in precious metals, all of these different kind of forces. And one of the things I learned in your book is when something's like really consensus, which I imagine American exceptionalism was consensus, that's kind of maybe a warning sign for you? Or is that one of those things that kind of flashes like maybe it's going to reverse?
Well, I spent so many years on the sell side, and all that means is banks. I was a trader at Lehman Brothers. I tell my wife once a month, as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock. And what I learned is the sell side, it's very safe for them in their mind to hide out in packs.
Interesting. Okay.
And they all play squash at the Westchester golf or tennis at the Westchester Country Club, or squash at these different clubs. They hide out in packs, and it takes a long time for them to reverse, right? And so by the time they reverse and put sells on things, typically you're at least 3 or 4 innings into what we call the new trade or the new investment thesis. So that's why you have to be very careful with sell side research.
Yeah. So I take it like what you're seeing transpire has not really surprised you.
No, because they had a theme in 2018 when the dollar weakened. Between 2016, we shared this with clients, like between 2016 and during the last Trump regime, 2016 to 2018, in that first 2 years, the dollar weakened dramatically. And you got to remember, we talk about in the book is that the United States has lost 5 million jobs in the Rust Belt. Mm-hmm. And they want a weak dollar. And the street had a theme back then. This is Wall Street research. It was called global synchronized growth. In other words, the sales pitch then was that, so by the end of 2018, when the dollar had weakened a lot, even weaker than it is today, The theory is that you really had to be invested in the rest of the world, not in the United States, because you had global synchronized growth. So to me, for investors watching us right now, what I've learned over the years is whenever you see one of these narratives constantly in Barron's, constantly in the media, any kind of media, constantly in sell-side research, you want to run. Don't walk the other way.
Got it. Okay, so frame up though, like just for folks, what does this new investing era look like?
Okay, I want to give Niall Ferguson,
yes,
probably the greatest financial historian that's ever lived, wrote the foreword to our book. We sat down in 2021 at the Harvard Club, and I'll never forget, he said to me, he said, Larry, never forget wars in a multipolar world like 1968 to 81 changes portfolio construction because it brings in an era of kind of like elevated inflation. Because if you think of like 1968 to 81, we were coming out of the Vietnam War. And his point was that, there's so many things about supply chains and there's so many different known unknowns in the world. But when you come out of that global conflict type period, it just creates more sustained inflation. So when we went from 1968 to 81, the market was basically flat those years. But if you had a portfolio of oil companies, gold stocks, copper, those stocks were up, I think in some cases, hundreds of percents while the market was flat. And so he really opened my eyes to how sustainable inflation can be in a multipolar world and in a world with global conflicts. Now just think about the Ukraine, right? We've had this horrible war. I mean, heartbreaking. I mean, just like it bothers me, how many people and then what's happening to some of these young people. And you think about like the rebuild of the Ukraine. Think about the global copper supply that's been suppressed by a lot of good, well-intentioned, environmental caring people. Panama, an amazing country, has the most incredible copper reserves. Like the copper is relatively close to the surface of the earth. You can get it into the ocean in 5 minutes. And countries like Panama have shut down their copper mines. So here's what's happening. We're on a collision course with an explosion of copper demand from the Ukraine rebuild, from artificial intelligence. We have a $2 trillion rebuild of the US power grid that's coming right at us. This is a meteor coming right at our planet. And we have think of Chile, Peru, and Panama. What is that, like 50% of global copper production capability? And it's been politically suppressed. And it's not just in Panama. It's also in Chile and Peru. And so we've massively, massively underinvested, and we've massively, massively suppressed investment through political motivations. At the same time, we're juicing demand. And this is the trade that's coming at us. It's like a 1968 to 81 regime.
That's one of the trades is being, you're long copper then.
Copper, and you know what's great about, we're doing this segment this week? Historically, every single economic cycle in my lifetime, when inflation probability or the probability of a hard landing goes up, copper stocks get annihilated.
Yeah, it's one of those economic indicators people often point to.
Yes.
Yeah.
And so think of like investors have been conditioned. Like if you're in your 40s or 50s, you just witness copper stocks get destroyed over and over again in recessions, right?
You have to look at it differently then.
Exactly. So this creates a great buying opportunity because the copper names are trading at very good valuations relative to this meteor coming at us, which will be this copper crisis. But because of the recession probability rising, investors have really, so if you look at copper names relative to the S&P, I think the drawdown is much greater. What is the S&P? S&P is 10 to 14% off the highs, depending on S&P or NASDAQ, maybe 17 from the NASDAQ. But like you're talking about copper names that are off 30%.
Monetary Metals offers you the ability to grow your wealth outside the banking system and gain greater control over your finances through gold. Increase your precious metal ounces every single month. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities to earn 4% on gold, paid in gold in their marketplace. And the interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. One of the things I learned in the book is it costs like $1 billion to even bring a copper mine online. I love like learning the little facts in the book too, just things I didn't know. Okay, that's an interesting play. Precious metals, another area of interest. Gold, I don't have the gold price in front of me, but it hit an all-time high today. So north of
3,300,
which in the book, when you wrote it last year, it would have been around 2,000 when you wrote it. But you said in the book like 3,300 was like the equilibrium if you took like the M2 money supply and I guess the supply of gold. I don't know the exact equation, but okay, let's talk about gold. What do you make of gold at this level?
Yeah, gold is like
take.
It's a $16 trillion pool. So it's the most luscious, beautiful liquidity pool of capital in the world. I mean, the problem with Bitcoin, we're big Bitcoin supporters, but what is it like? 30 families control something like 60% of the float of Bitcoin. And something like that. It's a bottom line is if one family, because of a liquidity issue, needs to lighten their Bitcoin, they're going to dramatically knock the price down. And that's what happens to young people. It's so sad because Bitcoin has this great thesis around, the fiat currency problem and independent finance. So all these things are sexy and beautiful. But if one big family in a liquidity event, in a risk-off event, needs liquidity and they go to the market and they sell and they have to sell, say a big holder is going through a divorce or something like that, it can really hammer the price. We saw this in August. We had this crisis around the yen, the Japanese yen.
Yes.
And, Bitcoin was off like, I think 25, 30% in 3 or 4 or 5 days. I mean, that's not a great store of value. Gold, on the other hand, gold's largest drawdown, the last 10 years,
I don't know.
The largest drawdown is 22%. Bitcoin's had 3 drawdowns of close to like 80, 85, 90%. The NASDAQ's had drawdowns of 35, 40%. S&P's had 35 in COVID, right? So gold is this incredibly liquid pool of wealth. 16 trillion that central bankers, if they're worried about the dollar, if you're a European investor and you're getting hammered on your stocks, your bonds, and your dollar, you're going to diversify into gold. And so that's what's going on. But we're recommending right now, like we do trade alerts, and this year, to me, one of the great gifts we talked about with the clients, Mali and Barrick, right? Barrick had this crisis. Barrick Gold had a crisis in Mali. It's a country in Africa around some of their mines, and the stock in the first quarter was absolutely hammered. And the sell side, banks all downgraded Barrick at around $15, and today it's $21. And so we recommended clients today just, cut the Barrick position down by 30% and really back up the truck on some of these copper names.
There you go. How about you said copper names, gold names, or?
What I mean is I think people have made so much money in gold stocks and gold.
Okay. Cut back on that and then back up the truck on the copper.
Yeah.
Do you not see gold? Does gold not have further to run here? Or it's this was the equilibrium price you put in the book, but.
This is a sexy one-liner, and I think it has a good chance of happening. There's a decent chance within the next year we're going to have 4,000 gold and 4,000 S&P 500. So we're still bullish gold, but
right.
The one thing about gold you have to be careful with is when you get at this point in a cycle, you want to start diversifying into other metals. Just look on uranium. It's not necessarily a metal per se, but you've had a seller in Kazakhstan. Now, the way Russia works, right? Think of uranium. Think of artificial intelligence. The next
energy,
the next 20 years, right? All of that artificial intelligence needs independent power sources. So you need nuclear power. You need SMR, small modular production of energy. And so uranium's been annihilated because of this Putin move around his provinces. And so you got uranium, and uranium stocks are 35% off the highs. Gold's at an all-time high. And it's because the way Putin works in Russia, it's just like The Sopranos, right? When he has bills to pay, in The Sopranos, Tony and his boys would go around to the different construction companies, right? And they go to the restaurants and say, oh, let's have a little conversation, Mario, right? And they would basically just suck money away from their allies. Putin's doing the same thing right now in Kazakhstan. He's putting massive pressure. He's got bills to pay from the war. And all of a sudden, there's this mysterious seller in the market, right, of uranium the last like 3, 4, 5 months. And meanwhile, all the tourists, these what we call new investors that were getting, imagine like the tourist investors getting off the bus with this, with this camera and the shorts, and they're basically like new hot money that came into the nuclear trade because, oh, we've got artificial intelligence. Oh, we've got the Trump administration's pro-nuclear. So in the fourth quarter of last year, all the tourists were getting off the bus and getting into uranium and uranium stocks. This trade, these tourists have been hammered and they're exiting. And when you see the tourists getting off the bus and you watch for that capitulation, then it's time to invest.
Interesting. Okay. You have a bunch of indicators. I don't know, probably 21 plus different indicators. I know it's a lot, and obviously can't share all of them, but are there any, because that sounds like maybe that's a bit of an indicator towards getting off the bus. Are there any interesting ones that are kind of flashing for you these days? Like what's a good one? Well,
for equities as a whole. Mm-hmm. Now remember the S&P 500, if it falls, so the street was looking for $270 of earnings, right? Mm-hmm. I talked to one of the most brilliant institutional investors this week, and a couple of different guys are saying the same thing. The real earnings are probably going to be $230 to $240. That's because of tariff risk and economic risk. So the street was looking for 270. We're really at 240. They call it 230 to be conservative. If you take 230 with an 18 multiple, so that's a PE of 18 on the S&P, then you're really down at 4,200, right? And so the S&P is still expensive. You're still way up above 5,000. But the indicator that we're seeing now that's getting really attractive is the percentage of stocks that are above the 200-day moving average in the S&P. So if all you did the last 20, 30, 40 years was buy stocks when the percentage of the stocks on the New York Stock Exchange or the S&P is below, say, 15%, 20%. That means very few stocks are below their 200-day moving average. Every time you bought stocks or started to buy stocks that way over the line, and we talk about this in the book. It's called the Tepper. This is what we call the David Tepper signal. He typically starts to buy stocks when the percentage of New York Stock Exchange or the S&P stocks that are above the 200-day moving average gets down into the low teens, even below. And those are typically the great time to buy. That's actually happening now to some extent.
Now, okay.
But what I think it's saying is, inside the market, there's a lot more pain than what's at the surface. In other words, the S&P is still way above 5,000, but internally, there's a lot more pain. So there's a lot more stocks that are down 30, 40, 50% that you can buy. I mean, you could buy Weatherford or Schlumberger. I mean, these are incredibly valuable companies in terms of their next 10-year outlook, oil services, and you're talking about stocks that are like 40, 50% off the highs.
So you're talking about getting back to like stock picking, the value investor playbook then.
Yes, value stocks, but you don't need pick stocks. You can buy the OIH ETF, which owns a basket of these things. But my point is that inside the market, the beast in the market, that serpent.
Yeah, what is that beast right now? Yeah.
The serpent inside the market has destroyed a lot of companies. They're very cheap. The free cash flow yield on Weatherford, for example, WFRD, you're way above 10%. You're way above, I think it's like 12, 13, 14%. And those are the types of stocks that great value investors are looking at right now. They're a lot cheaper a lot cheaper than the market.
But you also see pain ahead that we could see 4,000 for the S&P.
Yes. And what we're saying there is that, okay, energy stocks as a percentage of the S&P 500 probably go, right now you're 3-4%, call it 4. In the book, we make the case that energy stocks as a percentage of the S&P 500 goes back to, in the old days, you were way up there. We're probably going back to like at least 10 to 12% of the S&P 500's composition. 5-10 years from now is going to be energy stocks, right? So even though the S&P could fall down to 4,200, you're going to have that money. Remember, there's still 21 trillion in the NASDAQ 100. Okay, so here's a great stat. 10 years ago, a little bit more than 10 years ago, the NASDAQ 100 was worth 4 trillion and the energy stocks were worth 3 trillion. Just keep it simple. Okay. So 10 years ago, if we were sitting in this chair, NASDAQ 100, 4 trillion, all the energy stocks, 3 trillion in the world. And today we were at 27 trillion for the NASDAQ 100 on February 19th, 27. Now we're at 21 roughly. Energy stocks are still down at 3 or 4 trillion. Right? So I think about 3.
Okay.
So in other words, the NASDAQ 100 has gone from 4 to 27 back to 21 trillion in valuation. And the energy stocks are roughly the same. And so when you go into a world with elevated inflation, higher bond yields, global conflicts, it creates like this massive rotation of capital out of growth stocks into value. And so this money migrates it's a migration into other places. Energy is one of those places. Yeah, oil services especially.
And you and I have talked about that a lot of investors have basically had trillions misallocated leading up to this.
Yes.
Yeah.
And that's the Europeans, for example. I mean, you talk to them, they had to overinvest in the United States. There was no choice. So if you look at valuations at the end of last year, the U.S. is trading 21, 22 times earnings. European stocks were like 14 times earnings. And the emerging markets were like 12 times. So, and it's been that way for a while because American exceptionalism, people were forced into this crowded trade. And then the passive universe was even more evil because, and it still is, because once the percentage of passive stocks, what I mean is passive, like
the passive bid.
Yeah, like the percentage of the stocks. So you get active and passive. All that means is passive is index funds.
Yep.
Index funds that own a certain amount of stocks. And so everybody, as the passive market share went from above 50%, every percentage point it went above 50, it forced more people in to the S&P 500 because they were forced to buy it. And then the active funds that are, say, the Fidelities of the world, all these active funds were forced to kind of chase the passive, right?
Right.
And so you had this like
distortion almost, right?
Distortion and then you had the European investors, the Asian investors, everybody was just shoehorned into this crowded trade, and now it's unwinding.
Okay, that's an interesting way of putting it then. All right, let me go back to tariffs, since that's kind of been the big talk. That's the big topic these days for the past couple of weeks now, 2+ weeks at this point, April 2nd, Liberation Day, which is my birthday too. What kind of conversations are you seeing take place? Here's the thing. You talk to the smart money. Like what are they? What are the kind of the things that they're bringing up right now? What's the debate? Because I imagine it's also a divisive issue as well.
So Trump's support in January was the most powerful he's ever had. And his approval rating was incredibly strong historically in January. By taking the sledgehammer and having Navarro and Lutnick making that kind of relatively idiotic presentation, they basically shotgunned tariffs at the world instead of being more selective. And the presentation looked good in terms of, okay, it's easy to understand. They did it with graphics, but it was really foolish, I think. And I think Trump's going to force either Lutnick or Navarro out of the White House as kind of a potential fire blanket or a fire hose on this situation, because the planet Earth, one of my clients in Europe said to me, he said, Larry, we've all been in relationships, right? We've all been in relationships in our life. And we've all had those moments where there's something that you can't unsee, right? So if you're a global investor and you saw this move in the Rose Garden, it's just like the trust was broken. And that's what's creating this massive river of capital away from the United States. And so the only way to earn that trust back, and it's going to take a while, is what I'm hearing is some of the big Trump donors, especially in the agricultural space. Mm-hmm. Chuck Grassley has a bill in the Senate, and Rand Paul has a bill in the Senate to try to limit the executive branch powers of tariffs. There are people that think, highly respected people, that think that, oh, this is a potential constitutional crisis. So there's a movement within the internal workings of the GOP. The Koch brothers are funding these bills. Mm-hmm. Not bills, these cases that I think they want to get them to the Supreme Court, because the center right of the party that's not really MAGA, mm-hmm. they are trying to arrest the executive branch powers on tariffs, which is essentially taxation, right? So Trump's view is, and this goes back to Biden, we need the tariff revenue because we just did since 2020. And some of this is Trump's fault, right? Because we had the COVID, mm-hmm. but they basically jacked up the deficit by $11 trillion. One of the things I talk about in the book,
right.
The fiscal and monetary response to Lehman Brothers, which was the greatest financial crisis in history, was $4 trillion. Mm-hmm. The fiscal and monetary response to COVID, the regional bank crisis of 2023, and the Biden team jacking up, with the approval of Congress, jacking up spending in the election year, right? That response was $16 trillion. So just on the fiscal side, it was $11 trillion since 2020. And so this whole thing is Republican and Democrats' fault, because the Republicans' view is, hey, you guys jacked up deficits. We need tax revenue, right? Mm-hmm. We need to raise taxes through tariffs on our counterparties around the world. And if you don't raise taxes now, eventually people like Elon Musk are basically saying we either have to cut spending by trillions or potentially increase taxes, or else we're going to go into a default.
Does the math work out? Can it work out? Sounds like we might be sitting on a bit of a debt bomb, if that's fair to say.
Well, I think eventually it's going to work out. But the problem with the Trump team is that there's like this in-between stage where you float the tariff idea because you need tax revenue. Right. Tariffs are just, they're essentially consumption tax, right? To keep it simple. The media is not really being that truthful about tariffs. I mean, if you think about, there's a lot of wealthy people that consume things. Tariffs are a tax on the wealthy. They're also a regressive tax on the little guy, because people that are suffering from inflation, they don't have a lot of disposable income. When you raise tariffs, it hits them harder. Mm-hmm. So tariffs are a regressive tax, but the wealthy spend more. So tariffs are also a tax on the rich. And so this is a tax that Washington feels they need that revenue to offset, this huge, colossal deficit that's been built by Democrats and Republicans. Mm-hmm. And so where does that take us? The probability that you try to have this is where you could get a rally in the market over the next year, because if you have Democrats and Republicans come together and try to stop Trump, at least they want more control over tariffs, and where you give global investors certainty and visibility on tariffs, that's what markets want.
Okay, that's like the little seed that you're getting at from these conversations, this notion of a constitutional crisis. And if they can solve for that, you could see a market rally. But
in the meantime, we're in this, interest as a percentage of tax receipts is up at 20%, way above the rest of the world. Oh, by the way, if we raise taxes on the world, that's going to hurt consumption, and that creates uncertainty. Your tax revenues can go down in recession. So imagine if your interest as a percentage of tax receipts are like 20%, which is, like I said, 3 times the rest of the world. And then all of a sudden you go into recession and your interest costs, your tax receipts go down because you're in a sort of softer economy. Yep. That creates more uncertainty. So in the end, the Republican view is deregulation, open up markets, get a better situation in global trade with more visibility from the rest of the world. That's a good thing. But we're in this like in this unknown spot. And this is what clients are saying. What Trump did with the sledgehammer, he basically took, and if you just look at systemic risk, if you look at the basis trade, if you look at leveraged loans and private equity, and all the leverage that's over there, right? All the leverage in the world. Trump with that sledgehammer, they didn't realize it, but they've created, I think, 20 more known unknowns.
More uncertainty.
Yeah. And so it's a like Lehman in the sense that one of the problems with Lehman Brothers, right? When it went down, it was a $680 billion explosion. And there was a 5 to 7 month period where all the investors in the world, they didn't know who Lehman was going to take out, right? So they couldn't invest. It was like massive explosion in known unknowns. This is similar because you took a sledgehammer, you tried to even the playing field on tariffs. They meant well. There's been 40 years of really horrible policy in Washington. We've lost 5 million jobs in the United States, 5 million. I mean, this is like what they're trying to do, what they're trying to fix needed to be fixed. We talk about in the book, life expectancy in the Rust Belt. I mean, J.D. Vance is from the Rust Belt. He's our vice president. Life expectancy of 50-year-old men in the Rust Belt, working class states, is falling at the fastest pace in decades. And it was falling before COVID, right? So they meant well, but the sledgehammer created a Lehman situation with a lot more known unknowns.
Interesting. Okay. One of the things I learned in your book is that the bond market is where you want to pay attention to because that's the one that has the sniffer that sniffs out where things are headed. Are we seeing those signs? Are we seeing those signs in the bond market? Is that where the signal for this Lehman kind of moment is coming from? Like what? Okay.
So think about this. When Lehman went down, stocks lost $8.5 trillion of value, but bonds made you back $3 trillion.
Yes.
Wow. COVID, investors, their 401ks, investors in the United States, they stocks lost $9 trillion in COVID, but investors made back $4 trillion on the bond side. Today, stocks have lost $9 trillion since February 19th, roughly, and you've made almost no money back on the bond side. And some investors have lost money on the bond side. And you've made no money on if you're a global investor, the dollar's a lot weaker. So you've lost money there too. So what that's doing is that's creating a lot more risk indicators because investors are in potentially even more pain than they were under Lehman Brothers. So the bond market's telling you that because of these deficits and because global investors are shocked, that the U.S. is kind of acting a little bit like an emerging market country. If you look at, I sat down with Andre Estefes. He's a great guy, CEO of BTG Pactual in Brazil. I was in his office in Sao Paulo. And he talked about Larry. He said, you Americans, you're spoiled because you've always been the reserve currency of the world. You've never had to deal with a weakening stock market, a weakening bond market, and a weakening currency at the same time. That's an EM problem, right. An emerging markets problem. And he said, in fact, this is one of the most brilliant, this is next to Carlos Slim. I think he's one of the most brilliant Latin America investors, most brilliant investors in the world, but he's from Brazil. And he says, don't be surprised if you're looking, sometime in the next 5 years, you're looking down the barrel of this emerging market type problem that we've been dealing with for years.
Wow. So total generational change then.
Yeah, well, they have to put this fire out because the U.S. capital markets, when your stocks go down, your bonds go down, and your currency goes down at the same time, and that rate of change is violent, then you're acting more like an emerging market country, and it snowballs. Mm-hmm. It accelerates the white water of capital out of the country, and so the Trump team is dealing with this. I think their awareness of this problem has gone from here to here the last 2 weeks. I think now they realize that with the sledgehammer, they've created these known unknowns and they're going to try to reverse it. But once again, like my European investor clients have said, there's some things that you just can't unsee.
Wow. What a great place to leave it there. But before I let you go, Larry, let folks know where they can follow your work, subscribe to any of your work. Obviously, folks, go pick up a copy of How to Listen When Markets Speak, because it has in the last, 2 weeks become like it's gone up on the bestseller list. I know it's been out for a year, but incredible read. I did the audiobook version, which I loved, like the dialogue. That was really cool to listen to. Let's leave this audience with some parting thoughts as well. Anything that you would like them to think about in this kind of radically reshaped new environment?
Well, I started off on the retail side of the business in the 90s. I was a stockbroker. And what I realized, and this is great insight for people, I realized that by the time your financial advisor gets the research, it's picked over by the institutional investors. And we created this book and the Bear Traps report to democratize information. Give people an access to what the professional institutional investors are saying, not necessarily what the banks are saying. So when the banks discover research ideas, a lot of times they share those ideas with the institutions first, and then eventually it makes its way to retail investors. So I think that's most of all is you want to subscribe to research products like the Bear Traps report, like the Daily Dirt Nap, like Hedge Eye. Independent research, I think, is key right now, because you want to have a lens on a different conversation. You want ideas that are not necessarily biased from banks that have an axe to grind, right? And that share research with different clients at different times.
I love that. Yeah. And that's why I love hosting this show, because I get to talk to amazing folks like yourself, and this audience gets to listen and learn from people like you, and just really, really appreciate you being so kind and so generous with your time. Thank you again. And congratulations on all the success of your second book. Your first book was amazing too. But Larry McDonald, founder of the Bear Traps report, author of How to Listen When Markets Speak. Really appreciate you taking the time.
And it's great to be back in New York. And It's great to hang out with you.
Truly.
Appreciate it.
Thank you.
Okay.